Let's move on to today's rally. Just the latest in a big move in a week plus of volatility. And our next guest says not to let your guard down just yet. Do not become too complacent. Let's bring in Mandy Zhu of Credit Suisse to help us break it all down. Mandy, great to have you with us as always to kind of take us through a little bit of the signposts that you are seeing. What exactly is the market telling you right now about what that next leg could be?
Sure. Hey, Dom, it's great to be here. So I would say what really stands out in the options market right now is not just that volatility is higher, which it is if you look at the VIX index, but many of the other metrics are actually approaching the record high that we saw back last March during the depth of the pandemic sell-off. So for example, if you look at the cost of puts versus calls, so a measure of demand for downside protection, that is nearing the record high that we saw last March, which is very surprising given that last March, VIX was at 80. Now VIX is up, but it's still, relatively much lower. And obviously, March, S&P had a much bigger sell-off. So in terms of, what is driving that move, I would say three things. So obviously with the new variant, Omicron, a lot of uncertainty regarding that. But in addition, I would say this hawkish turn from the Fed that really caught a lot of investors off guard last week. And then last but not least, I do think seasonality has a part to do to play in this. We're coming into the end of the year, traditionally, a time where liquidity is a bit challenging and where moves in the market can get a little bit more exaggerated. So I think kind of put all this together, this is why some of the risk metrics in the option market are as high as they are.
So Mandy, I wonder, though, because we try to juxtapose that to many of the statistics that we often cite and have for years about this seasonably strong aspect of equity markets, specifically between Thanksgiving and the end of the year, not to mention that so-called Santa Claus rally that kind of takes us into the first part of the next year. But you have to square that with the liquidity situations you were talking about. What exactly then is the strategy, given that you feel as though traditionally it's supposed to be good, but that you can't let your guard down because the liquidity may not provide for that kind of support going into this particular year end?
So I would say liquidity works both ways, right? In a thin liquidity market, moves in either direction can become exaggerated. So liquidity becoming lower does not necessarily mean that the market will sell off. But certainly this year, I think kind of going to the year end with the macro backdrop that we have, what we are seeing is even more than usual, a pullback from investors. A lot of people, especially if they have done well this year, investors are cutting back on risk and really kind of trying to lock in year-to-date gains and trying to start afresh next year. But in terms of strategies that we like in this environment, I think looking at option strategies where you're net selling volatility make a lot of sense to us, given how dislocated the metrics I talked about have become. So, for example, if you are cautious on the market, looking at buying a put spread and selling a call to fund it, this type of structure where you're net short vol make a lot of sense to us.
Mandy, you mentioned some really good points that I tend to agree with in terms of volatility and skew. I think you kind of spoke to the demand for downside risk, and you hit on it a little bit on your last point. But in terms of what type of strategies would you suggest investors take? You mentioned some collar type of situations, but what do you think about 1x2 put spreads or put spreads as a way to kind of sell that skew and get yourself net short vol?
Yeah, absolutely. I think that type of strategy, so we like it. So if you're looking for protection, on the S&P 1x2 put spreads, take advantage of the expensiveness of skew or protection that I mentioned. But as a more direct short volatility play, we also like actually buying 1x2 put spreads on the VIX. So it is a way to position for a normalization in volatility in the VIX, while also taking advantage of the expensiveness of VIX options right now.
So one thing you can make a point on there, that the downside volatility has led to elevated options prices for that put protection. Mandy Zhu of Credit Suisse, thank you very much. Always great to get your thoughts. Have a nice evening.
Thank you.
All right, let's trade this, folks. I mean, okay, Karen, I will start with you. Some great points. The elevated volatility means that there is relative value, or the implied volatility of some of those put options have given you a chance to maybe be able to capture a little bit of relative expensiveness by selling them. Is that the way that you would approach this coming year, even though we always talk about this idea that things are pretty good between, November to December?
Yeah, I mean, if you want to lock in gains, that sort of makes sense to me. The put spread one with selling out of the money call to fund the put spread makes more sense to me. Just the idea of a 1x2 put spread. I did a 1x2 trade early in my career. I hope it's the worst trade of my career. It certainly is until now. And I just don't love that, potential for tremendous risk. The put spread with the call, that's easier because I am long. And if the market really rallies hard, okay, that's, I don't know, that I feel more comfortable with. But I guess my portfolio, I don't think of it, how's it going to do for year end? Because I'm hanging on to all of it for year end into next year. I got a further horizon than that.